Hello, Uncle Jim here. Today I want to share with you one of the greatest ways to make passive income, and that's selling options. And one of the most important parts of selling options is using a balanced approach. You may wonder, what do I mean by a balanced approach? I simply mean you need to sell both calls and puts. I'm going to share with you how I do that. I'm also going to share with you some trades, so stay till the end. I think you're really going to enjoy what I have for you. Okay, let's go ahead and jump in and get started. I do like to kind of make some comments about the market at the beginning of most of my videos. So I feel like it's been a surprise with the market, especially this week. I thought maybe we would have a down week with earnings coming, but we've had another up week. I mean, every day this week, I believe the NASDAQ may be down today, but we've been up 7 or 8 days straight. So we're definitely in bull market territory with, I believe the NASDAQ definitely is bull market. We may even be in the bull market for the Dow, at least in relation to our lows in October. I think we are definitely 20% above those lows, which is kind of surprising. I really thought maybe we would have kind of trended down a little bit this week. But now, do I think this is going to continue? I do think, we may kind of go down a bit in the coming weeks. The NASDAQ is down today, primarily, I believe, because of earnings. I think some of the bank stocks are down again. I know Discovery was down big time today, and Truist also was down. I think they slightly missed their earnings, and the market is very unforgiving. You miss your earnings, that's going to hit you hard, and that's what happened with Truist. So I think that's going to continue. I do think the Fed's going to increase rates next week, which, again, will probably be a little bit of a headwind for the market. I don't think that the big companies are having as many issues as small mainstream America, small businesses. I think small businesses are hurting a lot more. They're having a harder time finding capital or getting loans. They're also having a tougher time finding employees. And that's another reason I think the Fed is probably going to increase next time or next week and then potentially stay steady in September, is because unemployment is so low. But I think things are very different than previous recessions. I think employment's going to stay low. So many people are retiring. There's fewer people coming into the workforce. I do believe a lot of teenagers aren't working or maybe only working part-time. So I think they shouldn't look so much at unemployment as they have in the past. And I do think even unemployment claims is going up. So I'm not sure about their numbers completely, but I do think compared to previous recessions, we're going to have higher or lower unemployment during a recession. And again, mostly due to so many people retiring. And, the reason I think they're going to hold steady come later in the year, September, may even lower late in the year, maybe in December or January, they may start lowering a little bit, is the CPI and the PPI both came in low, showing that inflation is getting under control. And I've seen that a little bit in food prices at the grocery store. So that's my main reasoning to think that they're probably going to stay steady and maybe lower later in the year. Now, I do think the higher rates, are, like I said a minute ago, are having a pretty big impact on mainstream America. I know even for me, my HELOC is way up, and other things are up that probably, even with inflation or bringing inflation under control, won't change. Things like taxes, like my home taxes went up 15 or 20%. My home insurance has gone up. My car insurance has gone up. Those things I think will continue to go up, and the Fed won't have any impact on that. So, and one other thing I wanted to mention, this fight against fossil fuels, I think is hurting us too. I think energy prices are up some, not as bad as I would have originally thought, but I think this war against fossil fuels is hurting. I did hear ExxonMobil came out and they found a new fracking procedure where they can actually produce more oil from the same process. So I think our oil reserves and our gas reserves, we have plenty. So hopefully, if the government backs off of that and allows energy to be, you know, more produced at home, and we stop our dependence on other countries, I think that will help too, because that's having an impact on a lot of our inflation, because it's a core piece of what's used to produce goods. The fact that if energy is costly for the manufacturers, then the end price will also be higher. So at least my 2 cents, and as always, it's probably only worth 2 cents. So now let's jump into the main title or purpose of this video, and that is actually, having a balanced way of trading options, and that's actually selling calls as well as puts. Now, when I say puts, I'm meaning both vertical put credit spreads and cash secured puts. For me, all the types of puts I sell are secured, meaning I have enough cash to cover them. I don't suggest naked puts or calls. Always have enough cash to cover whatever options you might be selling. But by selling both, it gives you the ability to continue to make good money both during up times like what we've had the last week. I've been selling calls and cover calls mostly this week and mostly last week, and I've done quite well with it. And I've also been able to close a lot of my puts. I think I closed 2 vertical put credit spreads this week, one in SCHD and the other one in Square. So kind of setting me up for when we do kind of go south again and the market does dive, I'll have fewer vertical put credit spreads. So that's really important. And the reverse is true. So if the market does dive and you've got a lot of covered calls and the security prices come down, well, you can close those covered calls. They become very profitable very quickly. Even ones that are long-term or what we call leaps, anything over a year. So a covered call that's over a year will also become very profitable very quickly. So you can potentially close them, and you should. So you can be prepped for when the market recovers and you get back into an upward trend or a bull market trend. And again, during those times when the market's down or certain stocks are down significantly, you can sell puts. You can sell cash secured puts. I typically will do cash secured puts on inexpensive stocks under $30. I'll do vertical put credit spreads on more expensive stocks. And I typically will do a $10 spread. So having both allows you to deal with good times and bad times. And then, if all you were doing were buying stocks like I used to do years ago, just buying stocks and being a long-term investor, kind of buy and hold, then, you typically would not do as well. Being able to sell options, but then also relying on dividends and for me, I keep most of the shares. I'll do something like what's called the wheel, but a lot of times I won't do the last piece of the wheel, which is letting them get assigned away from me, because I want to own them. I want to own those dividends coming in. I want to receive those dividends on a monthly or quarterly basis. So that's made a big difference for me. I've been able to maintain the same amount of income, both during, a down market or a bear market or a bull market. And even these, bear market bounces, or I guess you also have the reverse, which is a bull market drop. I don't know if I don't know what that would be called, but it can also happen in those situations. So, and then kind of taking a step back, even with the balanced trading, what's core or what's key is picking good securities. So I always encourage people, don't trade just to get rich or just to make income. I do that a little bit on a small percentage of my portfolio, but pick good securities, pick good ETFs, good companies. And you may ask, well, what is a good company? It's a company that has very little or no debt. If they're paying a dividend, they're growing a dividend. It's almost more important to be growing the dividend than paying a really big dividend. You can have companies that are in bad shape paying big dividends. So don't just look at the dividend, look at the growth rate of the dividend, look at the debt. Do they have an okay level of debt in their industry? I prefer companies, and I trade several like Zoom and Williams-Sonoma, and I believe there's a few others that have no debt and still pay dividends. Now, Zoom doesn't pay dividends. It's one of the exceptions of companies that I like to invest in that do not pay dividends. But, those are two key factors. Another, are they earning profits? Are they continuing to do well? If they're going through a tough time, like with the economy, some of the retail companies' numbers are coming down, like BKE, which is another really good company that doesn't have any debt, but their revenue forecasts have come down because people are buying less. And that's kind of why I realized that the economy, even though we're having a somewhat of a bull market, the economy is being hit, especially mainstream America. People are changing the way they buy. They're going with store brands versus major brands. They're potentially eating at home more versus eating out. Kind of backing off spending things, so they may not be making big purchases or purchases they would have in the past. So if it's a temporary dip, like the companies I just mentioned, that's okay. Now, we all make mistakes. Sometimes you'll find a company and it's not doing well. Examples for me are like Big or Lumen. And then in that instance, what I typically do is I'll try to, take a loss or take that loss. Like with Lumen, I'm planning to sell them before the end of the year, and I'll take that loss against my other profits or gains. And we all have losses. We all make mistakes. So one thing I've shared with my members is don't beat yourself up about it. It just happens. It's part of the territory. You're going to have some mistakes. You're going to have some bad trades that go against you. And it's just nature of the game. The important part is not to take too much risk. Be steady, take your time, pick the right companies, and just over time, it'll just grow, and you can do quite well. So, and then that brings me up to the point of, how I manage positions, which is also keeps it very balanced. I don't worry about, I don't look at the leaps. I don't look at all my trades all the time. I have a planning worksheet that I release to my memberships. I have 2 memberships. If you want more details, they'll be below. You can take a look if you're curious. But I release these planning worksheets on a weekly basis. At one time, I had one spreadsheet that just had all my trades, and I went away from that. It got too complex. So I release one every week, and it covers what will be expiring in the next 2 to 3 weeks. And that way it allows me to focus on the specific trades I need to worry about, or the specific positions I need to worry about. And then, I'll look at rolling, I'll look at closing. If it's an 85% profitable, then I will, look at potentially closing that. But I do use some common sense related to closing. If it's real expensive to close still, even though it's 85 or 90% profitable, then I won't close it at that time. How do I use that? I determine it, and almost like going out to dinner for 2 people. If it's that expensive, then I won't close it. If it's fairly inexpensive to close, then I will. Like today, I closed I think it was Square, and it cost me $15. So it was kind of a no-brainer to close it. So, and by focusing on the coming 2 or 3 weeks, you're able to kind of balance what you're looking at. You're able to, not be so overwhelmed by having so many trades or so many positions opened. So that works for me. And again, I release these once a week, and at the top of the spreadsheet, I kind of give some recommendations. Now the hard part of giving recommendations, like on a Sunday as the market is closed, and on Monday it could be a very different market than it was on Friday. So sometimes, they're always good companies, but they're not necessarily going to work out that week. So I do share that with my memberships, and I give them kind of a decision. If they want to look at the trade deeper, then they have some things to focus on too, of my favorites. I call them my favorites. And again, I put them at the top of the planning worksheet. So the next part of this video, I'm actually going to share last week's planning worksheet, not this week's, just to talk again about a little bit more about balancing and how it works for me. And it was mostly covered calls. I think I had 5 or 6 covered calls and one vertical credit spread. So let's go ahead and jump into the next part of the spreadsheet where we'll go into more detail. And as always, please hit that like button, subscribe. I'm a small channel. I want more and more people to find out about me. So let's go ahead and jump into that next section. Okay, I've opened up my spreadsheet. This is my planning worksheet that I released on July 10th, which was a week ago Sunday. At the top, I typically will provide some of my favorites. So these are companies that I'm looking at potentially trading in. And again, I'm using the chains on a Sunday. So, I mean, the market's not active and the market can be very different. So a lot of times these values can be very different on the Monday. So, but it gives a basic idea of how much you can earn potentially. And I will look at these, and a lot of times I will make a trade. I believe I actually traded CF that week, but I did not do a trade in O, which is Realty Income, C, Citigroup, or Dow, which is Dow Chemicals. The only trade I did was CF, but I put in the date, the expiration, the different strikes, what delta, and then what the average premium would be for that, and then a little bit about the company, why I like it, and why it's in the list for that week. And then usually I release it to my membership, usually Sunday afternoon or Sunday morning, and I talk about in a little more detail about why I'm looking at these particular companies versus others. Sometimes it might be because it's a group with no debt, or it may be a group that have especially high growth. So that's usually at the top of each of my planning worksheets. And then at the bottom are the trades that I make. And the new ones I add later. So you can see there were several new covered calls. And then, so I'll first put down any that are expiring in the next couple of weeks. And so this was 7/10. Several were expiring on 7/21. I had big and I rolled it. The short strike was $17.50, but big keeps going down and down. I think it's currently like $9, but I rolled it out. Current price at $8 at the time. I rolled it out, lowered the short strike, and I brought in $157. So what I've been doing with big is just kind of spinning it like a cash cow, in the sense that I want to earn as much as I can while I still own it. At the end of the year, I'm gonna sell the shares that I have. I think I have 100 shares or 200 shares, and I'll take that loss against any of my gains. So it was 157. The cost basis was 63.31, and it's like an 8.9% yearly return. Next was SCHD. I didn't do anything with it that week. Again, it was expiring on 7/21, so I left it as is. Didn't close it. I did close it this week, so I believe I closed it Monday or Tuesday. So it's but last week I at that time I wasn't doing anything with it, or I looked, I couldn't roll it. It was hard to roll with the market up. Next is SDY. I rolled it. It was expiring on 7/21. I believe, it was 132. Price was 122. I actually lowered the strike to 126, which was the 20 delta. So it was pretty far out, but now I believe it may be as high as 129 or 130. So it's really close to being in the money. So I should have kept it at 132, but I could roll it again. I only went out to 1020. I brought in a lot of cash, though. That was the other reason I really wanted to bring in a bunch of cash. So I brought in over $400, $429.40. The required capital or margin was $15,000. That's what my cost basis was, and it's like a 10% return because it was only for 3 months, with it expiring on 10/20. So it's literally 3 months from today. So one of my better, I do quite well with SDY with selling calls or cover calls on it. So. And it's one of the ETFs. I went with more risk with it too, because I do want to diversify out of SDY. So my main goal was to make premium. I'm going to replace it with SCHD most likely So, and that's part of the reason why I lowered the strike to 126. Next is F&F. This is a company that was assigned to me a while back. I believe it was assigned to me maybe in October of last year. And this is a new covered call at 40. And I believe this was right around a 20 delta, expiring in December. And I brought in 168. The cost basis was 72.48. So I am in the money on this one too. Or not in the money. I paid more than what, so the shares I own are currently below the cost basis. So I have a little bit of a loss with that, but I believe if it gets to 40, with 72.48 being the cost basis, it's right around 36. And I didn't write down the actual value. I believe it's right around 32 or 33. So if it gets up to 40, I'll be it'll be above the cost basis. It'll be profitable again. But this was a 5.4% return. Now, again, I do want to reiterate, for covered calls, I try to double my dividend. I don't necessarily try to make huge returns. To me, I'm successful if I'm able to double those dividends. So, and it's pretty inexpensive. It's been heard again because of the housing market. I believe they do special kind or specialized insurance. Might be title insurance and some things related to the housing market. So in areas that the housing market slowed down, they definitely have been hurt. Now, Cisco, wrote some new covered calls on Cisco. And I really like Cisco. I've mentioned that in a number of videos. So I've sold vertical put credit spreads on them. And now I also sell covered calls. I believe I own 400 shares of Cisco, but this was 57.50. And it also doesn't move a whole lot. It stays pretty much between 50 and like 55. I believe right now it's 52 or 53. Again, I didn't write the price down, but I believe it's around 52. So this was expiring on 1/19/24. I brought in 216. My cost basis is 93.95. That's what, so that's the cost basis or the capital basis, and it's a 4.4% yearly return, which is higher than the dividend, which I believe is a little bit over 3%. It may be 3.2%, but a good company for both selling puts as well as selling calls. It's not going to be one of your most profitable, but it's just a good company, well run. Now 3M, I also sold a new covered call. I did it for 115. It was a 22 delta, almost a 23 delta. I did it expiring on 11/17/23. And here my cost basis, I'm pretty close to the cost basis currently. So, but 3M's been struggling. They have a lawsuit relating to these hearing devices that are used by the military that a lot of the military people, their eardrums got injured because of the loud noise. It didn't really protect their ears. So there's nearly a class action lawsuit. I think it's going to become a class action lawsuit and probably will get dealt with by the government, meaning 3M will pay some amount to the government, and then the government will, hopefully take care of the military guys that might have had their eardrums or their hearing damaged. And for it was, 4.8% yearly return. Again, in this case, it didn't double the dividend, mainly because 3M, I think their dividend maybe is closer to 5.5, maybe as high as 6%. So this is one of the exceptions. It's been so hard to find premium with them that to me it was worth it, even though I didn't quite beat the dividend. In other cases, I have beat the dividend. So it's not a hard fast rule. It's kind of like that's the goal on average, is to double your dividends. So if you're earning on average for your account 3 to 4%, you're getting 6 to 8% when you tie or use covered calls as well as your dividend income. So next is CF, and this is what I talked about before. I shared the fact that CF was one of the companies that I liked. I believe it's one of the dogs of the Dow. it pays a nice dividend. It grows the dividend, and didn't take a whole lot of risk. So like a 17 delta, so it was 62.50, 52.50 for the vertical put credit spread. So all these were covered calls except for this vertical put credit spread. So I did 5 covered calls and only 1 vertical put credit spread. And I believe this week all I've done is covered calls. So it's kind of like this month is going to be the opposite of last month. Again, related to keeping your trading balanced with calls and puts. So last month I did primarily puts, and this month I'm doing primarily calls. And then again, I have a fairly similar number of outstanding calls as the puts. So I believe that, again, they're both right around 35 or 40. One may be 35 and the other 40 or vice versa. So 62, 52, 50. So with a 17 delta, did this, I believe, last Thursday or Friday. And I brought in 209, so really nice premium for 3 months. It's expiring 10/20/23. And so the required capital, again, is the 2,000, the 2 contracts, which each contract is 1,000 with that $10 spread. So $10 times, 100? So that makes it 1,000 for each contract. So you take the 2,000 minus the 209.40, and that's the required capital or margin. And this is, if it expires worthless, then it's like a 43% return. Most of my trades, I usually roll them or close them before expiration, usually 3 to 4 weeks before expiration, sometimes even more than that. Like I've rolled some September expirations recently. So that's almost 2 months before expiration. So, and then what happens with that then, if I close this 3 weeks early, it'll be probably more like a 50% return. So for those trades, I did 1353.95, or just literally almost 1354 for the week, which is one of my highest weeks. Now the previous week, I think I only did $500 or $600 because it was the 4th of July week, but this is definitely one of my highest weeks. And it was, like I said, mostly covered calls. So here's total for June. Now this, I believe I'm up to pretty close to 2,500 now. And then hopefully at the end of this week, I'm fairly close to 3,000. And then next week I do another 1,000. So I'll again be really close to my $4,000 monthly goal, which I show here, and a 1,000 weekly. Again, I try to keep it simple. I try to keep it steady. I try to do 1 trade a day and get as close to 200. And in doing so, I also try to take very little risk. I try to pick good quality companies. And as I increase these goals, like I believe 2 years ago, the goals were probably more like 1,000 a month and maybe only 250 weekly. So these are my goals. This is what's worked for me. And, this is after 2.5 years of learning how to do it the right way. So if you're, jumping into this and you're fairly new, set your goals accordingly. If your accounts are smaller, you may have to go with smaller goals. And if you're new to trading, start slow. Don't jump in too quickly. Learn the basics, learn the verbiage. The verbiage is very confusing at times. Close to open, open to close, sell to close, buy to close, buy to open. It can get really confusing. And I've made mistakes before where I put the trade in backwards, and you can fix it fairly quickly. You just re-enter the trade and run it again in the reverse, and you may spend $2 or $3, but at least you can fix it pretty quickly. Now, the first time that happened, I called Schwab all freaked out. I put the trade in backwards, and they walked me through how to do it. And that's another reason I like Schwab so much. They're there to help you, and they take their time. They don't rush you. So this is what it looked like this month or for this week. Again, it's stay balanced. Don't try to get rich quick. Slow and steady. So hope you enjoyed this. As always, add a comment. Let me know what you think. Am I missing something? I try to answer all my comments. So again, I hope you enjoyed this, and thanks for joining me.